Hello, I'm Brian Beaulieu from ITR Economics. Thank you for joining us for this March 1st edition of FedWatch. Some interesting trends took shape a little bit more definitively this week. M2 money supply data came out, and it continues to show encouraging signs about a reversal from money supply going down to money supply beginning to round the bend and rise. We still won't know for sure until we hit that crucial March data, but we're encouraged because the rates of change are moving upward. In fact, they've been going in a positive direction long enough now that they're probable rate of change lows, and that's very encouraging. Money supply is still 4.9% below where it was last year, but that number is getting less negative. And we see some 3-month moving average rise going on in the money supply, and the 0.8% increase is median, typical for the money supply. So we may be seeing that the Federal Reserve is a little slow in lowering interest rates, but they're not shy about trying to improve something that most Americans don't watch, and that is the money supply. It looks like they're testing the waters is the best way I'm thinking of it. Holding off on lowering interest rates until the second quarter, maybe even July, but I really think it'll be May or June. The other good news this past week was new homes sold were showing some signs of cyclical improvement. But here again, the increase was normal. It was a little bit low than average, and that's coming off of very low levels. Usually when the levels are very low and we're starting to get into a normal recovery trend, you'll start seeing some more better than normal or better than average results in the data. And we're not seeing that yet. So the situation is stabilizing. And that means, from my perspective, if I was the Federal Reserve, I'd be thinking, okay, it's stabilizing, that's good. And we don't have to worry about the economy running off again. However, this leading indicator isn't showing anything but a modicum of improvement at this time. The Fed's favorite measure of inflation, the Personal Consumption Expenditures Price Index, the PCE price index, came down with the January data. We were at 2.4% in the 112 rate of change, 2.8% if you looked at just core inflation that excludes food and energy. So just like at the CPI, we're continuing to see where commodity prices, goods are down. In fact, the PCE price index showed that goods declined in January and services rose because of the labor content. But even there, and I think the PCE data and the CPI data lags behind this reality. Labor wage inflation is definitely slowing. The 112 rate of change for January was a very modest 1.2%, clearly in phase C, decelerating rise in the actual data. And the 12 rate of change rather was at 3.9%. So we have a 112 and a 312 running below the 12/12 rate of change. So wage growth is slowing. The Fed's going to love that, and that'll help get the service component of personal consumption expenditures and the consumer price index to ease in their rates of inflation, generally speaking. We seem to be on track for interest rates coming down in general, not just the Fed funds rate in the second half of this year. We're already seeing mortgage rates coming downward. That's good for the economy. It's not necessarily good for every industry, every individual, but it is good for the economy. And it's a sign that the Federal Reserve is more comfortable with inflation. And that means we're on target for using 24 and 25 to really strategize how we want to handle the next round of inflation, which we see coming on the other side of 2025 in earnest. Thanks for joining us for this edition of FedWatch. We'll see you next week.